I'm Jim Lau, President and Wealth Advisor at TVH Financial, and I work with incorporated business owners and professionals who have built strong incomes but still need a more efficient way to save for retirement. That's exactly the planning gap I help my clients solve. When I speak with clients at TVH Financial about an individual pension plan, one of the first advantages I explain is that their corporation may be able to make tax-deductible contributions well beyond what an RRSP would normally allow them to set aside. When I compare the numbers for clients, I often show them that over a working career, an IPP can create roughly 65% more contribution room than an RRSP in many cases. That can mean a significant amount of tax-efficient retirement capital if we plan for it properly. When I walk clients through how an IPP works, I explain that the contribution room is not fixed. It generally grows with age, years of service, and the T4 income paid by the corporation, which is why the planning opportunity can become more meaningful over time. I also remind clients that if family members are actively working in the business and earning T4 income, they may be able to participate as well. Depending on the situation, that can mean joining the same commingled IPP or setting up a separate plan for them. When I explain why IPPs were less common before 2014, I keep it simple. Many business owners were paying themselves mostly through dividends, and because IPP room is based on T4 salary rather than dividends, the planning opportunity was often much more limited. From my perspective as an advisor, the planning incentives changed once CRA integration changes, passive income rules, and TOSI made pure dividend planning less attractive for many business owners. That pushed more compensation back toward T4 income, and in many cases, it reopened the door to meaningful IPP planning. For my Ontario clients, the opportunity became even more attractive in 2020 when FSRA exempted connected member IPPs from provincial pension regulation. In practical terms, that change helped make IPP planning more accessible and more flexible for the right clients. What that means for my clients is added funding flexibility. Company contributions no longer have to be mandatory in the same way, so business owners have much more control over how and when they choose to fund the plan. When I explain the long-term value of an IPP to clients, I focus on two key advantages. While the assets stay inside the plan, they can grow on a tax-deferred basis, and they may also benefit from strong creditor protection, which adds an extra layer of security around retirement capital. I also help clients look at how this structure can support intergenerational wealth transfer, create terminal funding at retirement, and in some cases allow for optional deficit contributions when the plan permits it. Those planning features can make an IPP especially valuable when we're thinking beyond just annual contributions. When CRA started challenging capital gains splitting, advisors like me had to focus more closely on strategies that could still move retirement planning forward in a clean and effective way. For many clients, that brought the IPP back into sharper focus. I also introduced the RCA to high-income clients as either a companion to an IPP or, in some cases, an alternative planning tool when they need additional room beyond more traditional options. In some client situations, I don't look at an RCA as a replacement for the IPP. I look at it as something that can sit alongside the IPP and add another layer of tax-deferred retirement funding when that makes practical sense. I also explain to clients that an RCA can stand on its own in the right situation, especially if they're over 71 or if there's a one-time funding need such as executive severance. If you'd like to explore what this could look like in your own situation, I can help arrange a customized no-cost illustration so you can evaluate the opportunity using real numbers, not just theory. When I do that personalized review with a client, the goal is to determine whether an IPP, an RCA, or a combination of both is the better fit for their income, age, and retirement objectives. If this planning gap sounds familiar, I'd welcome the opportunity to speak with you. Reach out to me, Jim Lau, and let's have a conversation about what may be the right fit for your situation. If you'd like to discuss your situation, please contact me directly. You can reach me at financial@tvhgroup.ca, and you can learn more at www.tvhfinancial.ca.